Welcome to TradeTheMBI.com. This is Jonas Reporters for the 15th, and here we have that malaise I was talking about, sort of stuck with the orange here between the cyan and red. Looks like it's starting to perk up a little bit. We still have continuation, though, of midterm buyers here in the green rising, which is a good thing. If it crosses above that cyan, we should get a spark that should elevate the S&P, get it past the highs right up here. A little ways to go, not too far. A lot of it's being held back because obviously you have some of the tech nightmares that I warned about, prior to the election. It's not necessarily a smart move when you're dealing with multinationals to take political positions, but obviously Amazon did, and they've really suffered dramatically for it. Apple and Google obviously as well for their positioning, and Apple to a less degree than the others, and then you got some of the other ones getting into it like Pepsi and stuff like that, and so it's just created all sorts of problems for these people. And they should just stick with business and their shareholders, otherwise you're going to have problems. It's not worth the controversy. Needless to say, though, we are seeing, I wouldn't call it necessarily a Trump rally as much as there's just nowhere else to put money, so this is the place to be. It'll be interesting because oops, do that, here we go, that back there. That was that long position that we had been talking about from before the weekend. Adding to, selling some, all good. Nothing to object about any of that. The NQ, see, it suffered from all of that retrace and that, it's not horrible in this particular enclave. You've got green above cyan. Shorts really non-existent in this. This is just a lack of new buyers lifting it up. If they pop back into it at any point here, could elevate things. But you can see the massive move into industrials with this expectation of potential move towards rebuilding infrastructure. So that's definitely Dow 30. I mean, that's the whole point of industrials. You're definitely going to see a spike there. Is it premature? Probably. Are you going to see a lot of this get retraced? Absolutely. But that's okay. We expected a move to the upside year end, and this is exactly what it is. There's nothing, it really didn't make any difference what the outcome was going to be. Now you have stability, and people can pre-position where they need to go, and that's just a rotation, and it still doesn't change the fact that rates are going to remain low. This is the problematic one for Euro. It's also going to put pressure on the U.S. You see, and this is a difficult one because you have to increase the prospects for U.S. growth when you're going to have a stronger currency. And the reality is that the dollar is going to continue to get stronger. Now, it's about a year ago at this time, if I scroll back, because I kind of shrunk this, but we can go back to right here. We were back down at the 106 range, which is just to the lower side of my targeted range. That would be the 1 year anniversary of making those lows. So we could be back down at that very soon here. The reality is we ended up with potential for the cyan to move below red, but in fact, all we ended up with was more of the same, where we got another little version of a DOC spread as it took place here. And it was crazy because we had overbought developing at the peak of this move, and even right as it started, and then as it was turning over, and sure enough, we continued to cascade lower. Still positive, so there's plenty of money that's still been put into it, and it still can't hold it up. So that's an indication central banks have been trying to support the euro. Hasn't worked so well. If we break down into a negative shakeout here, I would expect us to get down towards that, potential of getting near parity. That's going to cause a lot of freak out in Europe. I've been warning about TLT and getting out of this one, or being short really is the ideal situation. Just beautiful. No other way to describe it. It's easy when you get it right. Same with oil. We knew we were going to be heading down. And again, turning on the spigot is a double-edged thing. It's fine if you have the demand. But at this point, we even have a situation here in Europe. They have no more land facilities to handle the physical supply of both refined as well as raw petroleum, which means you just have nowhere else to put it. Now, the problem here is they don't really adjust price based on demand, so prices are going to remain fixed. So you're not going to increase demand at all here which means that that supply glut remains. And this is a fixture of socialized governments and I want to say, markets controlled by governments, because you can't assume that huge supply by changing policy or in this particular case by lowering price, which would be the typical thing. You would lower price, it would cause the excess supply to be sucked up very quickly, and boom, you would then be at equilibrium. That's just not going to happen the way that governments have overreached their control aspect. And this is going to be the interesting battle with the Fed going forward, because despite their desire to want to maintain low or no interest rates, they're not going to be able to, because if the economy starts to heat up on its own, rates will rise without their input. And that is something they really don't want, because if it appears the Fed has lost control of things, then, well, that will be a whole new era. And gold still continuing to suffer on that, because there really isn't the likelihood of inflation at this particular point, and an easing of tensions takes away that thrill factor of wanting to be in gold for global unease, because actually it's looking like there could be a peace dividend from the election, ironically. So this is what we had, pretty much flat to weak nothingness, still biased to the upside on it, easy enough to trade off those ABM resets here. We're moving back to the upside, getting a little overbought here, so probably retrace that. Would expect us to get back to this. I mean, normally on this kind of a move pre-market, when you come back, there's a push to want to get back up to those highs, and it usually happens. So I would expect us to get back up to that point, even if that isn't maintained. That's usually the market thrust. But it looks like there could have been an awful lot of accumulation within this move, as we stayed in a very tight range for the last couple of days here. If I shrink this, you can see the average weighted price pretty well within the bounds of right in here, the 2150 to right around the 2162-ish range. So it's a fairly narrow for them to be keeping that, which means I think that probably good size accumulation at this point for a breakout move. So that would be the expectation at this point. So we'll see how that plays out. But regardless, we're on the right side of things, and continue to explore all the avenues. As always, though, continue to look for me in the Skype chat. Trade well. It was a boring day yesterday with this flat action, but it happens.